In May of 2020, ibonds hit an annualized rate of 9.62%. Back then, I didn't really know what ibonds were or what bonds were in general. Still, 9.62% backed by the government seemed like a pretty good deal. After some initial research, it didn't take me long to max out my yearly contribution of $10,000. And when ibonds had a fixed rate of 1.3%, I did it again the next year. It wasn't until after I crunched the numbers for myself did I realize that ibonds really weren't so great, except for this one specific case, which I'll share with you in this video. But first, here's what I'm going to cover in this video: what ibonds are and how they work, why and when you should consider buying ibonds, and other investment opportunities you should be looking at. So what exactly are I-bonds? I-bonds are government-issued bonds by the U.S. Treasury designed to protect you against inflation. You can easily buy these from the U.S. Treasury Direct website, and it's the only place you can buy them. The interest rate is made up of two parts: the inflation rate, which changes every 6 months based on inflation, and the fixed rate, which lasts the lifetime of the bond. You add these two together to get what's called the composite rate. So if inflation goes up, your interest rate goes up. And if inflation goes down, your interest rate goes down. Sometimes inflation can actually be negative. This happened twice since I-bonds were issued, once in 2009 and again in 2015. When this happens, instead of having a negative interest rate and losing money, the interest rate will just be zero. Of course, they come with some restrictions. You can't withdraw I-bonds for the first 12 months. If you withdraw within the first 5 years, you lose the last 3 months worth of interest. You can only purchase up to $10,000 per calendar year and $15,000 if you're using a tax rebate. Bonds have a 30-year maturity, but you can withdraw them anytime after 1 year. There's a lot of good things about I-bonds. They are guaranteed by the US government. They are protected against inflation. They are compounded every 6 months. They are exempt from state and local taxes. You are only taxed when you withdraw your funds. And partial funds are allowed. So they're really simple products to work with. So what's the big deal? Well, even though the inflation rate is very good today, historically, however, the inflation rate is not. If we take the average inflation rate since 1998, when I-bonds were issued, the average is only 2.65%. If you assume a 0% fixed rate, this is a very low percentage. But if you bought when fixed rates were very high, this would make more sense. However, I think those high fixed rates might be gone forever. So with this very low percentage, you're not really growing your money, you're only protecting your money. And growing your money is the whole point of an investment in the first place. Now, if we compare that 2.65% to the S&P growth that happened during the same period, the S&P growth was a 7.5%. But what about when rates are really high? Aren't I-bonds good investments then? Now, if you wanted to invest when rates were really high and cash out when the rates were low, you can do that. Just be aware that the advertised rate of 9.62% was actually the annualized rate. The inflation rate actually changes every 6 months, so you're not going to get that 9.62%. You're only going to get that 9.62% for the first 6 months. Plus, you lose the 3 months worth of interest, and there's taxes to consider. But why are I-bonds bad if they preserve your wealth? Well, I'm not saying they are necessarily bad. What I'm saying is they are bad growth investments. Because I am young and I have a good time horizon, I would be much better off investing in the S&P 500 for growth. However, when I bought I-bonds, they were a replacement for my emergency fund. So this is a fund I have for emergencies, and I've actually never had to withdraw money from it. So instead of having that money sit every year in a high yield savings account, I can simply buy I-bonds instead. Now, for me personally, this worked. If you are using I-bonds for their intended purpose, which is to protect your wealth rather than to grow it, it's best to buy I-bonds when it has a high fixed rate. The fixed rate right now is 1.3%, and that will be in addition to the inflation rate. So you want to get the fixed rate when it's really high. If you already bought previously last year, it might be a good strategy to sell your I-bonds and then repurchase them with the new fixed rate. So let's put this all together. I-bonds are really good at preserving wealth, but they should not be a means to grow your wealth. If you are young, I suggest investing in the S&P 500, but if you have some savings that you don't want to touch for a while, I-bonds could be a good option for you. So what is your take on I-bonds? Do you have any? Leave a comment below.